Hello friends. Last week in my video, I updated you about the fact that there were a lot of WhatsApp forwards going around saying October is a good month for headline indices, and I presented you with statistical reasoning why it need not be taken at face value. Let's go by the weight of evidence rather than what appears in the public domain. And sure enough, the markets were fairly range bound. Now, as the thumbnail of this video suggests, there is a development in the Middle East, in the Gaza Strip to be more specific. And we have seen Hamas claiming to have attacked and indeed attacked Israel with over 5,000 rockets. Casualties have been reported, and there is a probability, and a very high probability, of a war. Will this spook the bulls? Will it spoil the party? There is a special segment in this video which I have covered in a geopolitical 360-degree worldview, which you so know me for. Don't miss out on that segment, and also do not skip out on the bond market segment because this is really important. Let's dive right into the statistical aspects of the market, and on your screen right now is the market roundup window, which tells you that the Nifty 50 just about managed to keep its head above the water, with the Bank Nifty coming down. Gold and silver fell in spite of the fact that the US dollar was marginally under pressure. Crude oil fell, which I have been telling you on my Telegram channel that the rally was unjustified. It was not really going to last too long. Whereas natural gas went up a little under 12%. One of the reasons is cost of carry. The other reason is the labor strikes at Chevron's Australian LNG plants are back. And now to add to it, on Saturday morning, you have the Hamas attacks on Israel. So it's going to be a fairly volatile week ahead. The USD INR rose 12 basis points, which means the rupee has weakened against the dollar. Indian 10-year benchmark bond yields have shot up to 7.31%, which is 11 basis points up. We'll come to that in the bond market segment. Please don't skip that. The NSE gained a little under 0.25% in market capitalization, which means the broader markets were doing fairly okayish kind of. MWPL went up 5.08%, which is routine after an expiry where the US markets are concerned. The headline Dow Jones Industrial Average fell a little under 1/3 of a percentage point, whereas NASDAQ and the S&P 500 went up. Friends, I now come to our in-house statistical studies. I first start with MWPL, market-wide position limits. Now, these are derivative limits utilized by traders against a total percentage of limits allowed by SEBI. Now, let's see what happened last week. We've seen the post-expiry week notch gains on the MWPL to 33.43%. MWPL tends to rise till the third week into the derivative cycle. But last week's rally to 33.43% is lower than a similar week in the prior month, which was 34.95%. So retail buyers and retail traders rather are definitely biting less and less into the market's pie. They're taking smaller bites into fresh positions. So this is the first weight of evidence. Now I go to the stock and index futures turnover. This is a weekly chart, and this is an absolute sum total of the 4 traded days. Remember, these are 3 concurrent series. So this is October, November, and December. One of the reasons why the turnover has fallen is obviously the week was shorter because 2nd October was a holiday. Secondly, the week prior was an expiry week, and you're seeing every 4 weeks there is a spike in the turnover because rollovers occur. But in spite of the fact that a fall in turnover was warranted, the decline in stock futures turnover to almost the lowest in a 20-week period, almost 5-month period, tells you that Marshmallow traders were a little cautious. This is another sign that retail guys were not really very gung-ho about buying. I now come to the advanced decline ratio, which is the average of all 4 trading sessions last week. The advanced decline ratio has improved to 1.17 as against the prior week's 1.12, which means for every 100 losers, there were 117 gainers. That seems to tell us that intraday traders were, relatively speaking, a little more confident as compared to the prior week in question. Now I come to the basis. Basis is nothing but the premium or discount enjoyed by the futures compared to spot. I had told you last week, and I distinctly remember that these lofty basis levels at 263 on the Bank Nifty and 71 on the Nifty 50 were unlikely to last. And sure enough, what you are seeing is that the Nifty basis has come down to less than 50% over the prior week, and even the Bank Nifty basis has fallen sharply off the cliff. That tells you that 2 Marshmallow traders, don't worry about the Marshmallow theory, it's explained in the description below this video as well as in the pinned comment in a tutorial video. The 2 Marshmallow traders were selling at higher levels, which is what compressed the basis. This is the third weight of evidence that bulls are not really as confident as they were in the recent times. Now for our exclusive in-house indicator, the impetus, which you won't find anywhere in the public domain. What you are seeing is that impetus in both the indices, Nifty and the Bank Nifty, fell. Now, even though the Nifty 50 has notched gains of 0.08%, the impetus has fallen. The Bank Nifty, of course, has declined 0.5%, but even there the impetus has fallen, which means there was no forceful buying or selling happening, either at higher levels or at lower levels. This is another indication that traders are actually just about participating half-heartedly in the market, and that's not exactly a very great sign. Another exclusive in-house indicator from us, the lift, weight, thrust, drag index, which you won't find anywhere else in the public domain. Now, what we are seeing is the Nifty has logged 0.08% gains last week after falling for a fortnight consecutively. Now, the LWTD reading has fallen to 0.09 from a prior week of 0.22. Last week also I had told you that the LWTD had fallen, which means fresh buying would be muted. And sure enough, you saw the Bank Nifty decline and the Nifty 50 just about managed to rise. This week, we are seeing the LWTD has fallen even lower than the prior week, which means fresh buying at higher levels will be muted. Does it mean that the market has to collapse? No, I'm not saying that. There are two aspects to it. Fresh buying, which means taking the market higher, and short covering. Short covering means slowing down the decline. Slowing down of declines by way of short covering can continue, but fresh buying is likely to be fairly limited. That is another weight of evidence that it is not really gung-ho. I now come to the most significant aspect of this week's video, the bond market. We take pride in the fact that I have been assigning greater weightage to the bond market as compared to the coverage that we give to the equity market, because we cover bonds before we cover equities. And the reason being that we subscribe to the theory, and of course substantiated by veteran traders, that the bond market fuels the prices of other asset classes. And on Friday, the RBI governor has kept the rates constant. He has also assured the market that the RBI is watching the data very, very keenly, and they would be going by way of a statistical weight of evidence on inflation, etc. But what has taken the market by surprise, and I mean a negative surprise, is the continued use of OMOs, or open market operations, in the bond market. What the RBI governor simply means is, whenever the RBI feels that they need to suck out liquidity from the banking space, they could come out and offer bonds by way of auctions or immediate sale. Do remember that on 1st October 2021, you had the RBI Retail Direct portal, which now allows a retail investor to bid and offer bonds directly to and from banks without any brokerage commission or intermediaries. So what the RBI governor has said, whenever we need to suck out liquidity, we will resort to open market operations or OMOs and issue bonds. And therefore, traders feel that the banking segment might just feel constrained where liquidity is concerned, which is why you saw the Bank Nifty decline and the Nifty 50 just about managed to rise. The fact that what you're seeing on your screen is the weekly chart showing that the bond yields have gone to 7.31. It's just about threatening to cross the downward sloping trend line. And bond yields are now at their highest after April 2023. That's a good 5.5 month high there. Which is why, if you remember on my Telegram channel, which happens to be free, no subscription charges, etc., I have been telling you that you need to have patience where laddering is concerned. Don't get into impatient mode. And I told you that if bond yields were to fall substantially, interest rates were to peak, I have plan B, which is gilt funds. But I have been staying away from gilt funds, and I have been telling you to stay patient, sit with your checkbook and keep the powder dry, because I feel bond yields would go up. And sure enough, 4.5, 5 months of patience are paying off. Bond yields are now at 7.3. Would I ladder the sovereign? Yes, I would definitely ladder the sovereign, provided I start getting 7.5 plus. Would I keep the powder dry? Yes, I would not let go of all my money at one shot, because I think interest rates are likely to last higher for longer worldwide. So let's be careful out there. And like I've been telling you, interest rate sensitive sectors are particularly vulnerable to volatility. So the equity markets will tend to take a note of this. Friends, bond markets done. I now come to the Nifty, Bank Nifty, and the daily chart on your screen tells you that this index has fallen on 3 out of 4 trading sessions last week. The head and shoulder that was made in the month of July has a red color neckline, which is basically acting like a chaotic attractor. A chaotic attractor is like a magnet where iron filings tend to concentrate and polarize around. So the neckline, which is a little under 44,500, is acting like a chaotic attractor. The price is below that. The price is also below a month-long moving average, which has now started to slope downwards, which means that the recent buyers in the Bank Nifty are under pressure and they are paying mark-to-market losses. Let's now turn to the weekly chart. The weekly chart tells you that the price had ever so briefly breached the 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So the medium-term outlook has also turned marginally nervous. And look at the chart pattern here on the weekly chart. It's resembling, or it is actually a rising wedge, which means the tops are getting shallower. They are not showing signs of vibrancy or strength. And remember, this is a mathematical chart. If I was to use a log scale chart, the peaks would be even more shallow and the rising wedge would be a lot more prominent. So the peaks are getting smaller and the bulls appear to be tired a little bit on the Bank Nifty. This goes in line with what I've been telling you. Interest rate sensitives, particularly banks, are vulnerable. Now, in the week before last, this index was at number 3 on the most volatile counters list as per statistical beta rankings that we maintain in-house. It fell sharply by 5 notches to number 8. Does it necessarily mean that volatility on the Bank Nifty has fallen sharply? Partially, yes, because of a smaller range. But Stock specific volatility has risen much more faster, which is why the ranking has fallen. Last week, I advocated an estimated range between 45,700 on the upside and 43,475 on the downside, which held perfectly well. In the coming week, I estimate a range between 45,450 on the upside and 43,275 on the downside. It's time to be careful, time to play light because volatility is likely to be high. Friends, the Bank Nifty done. I now come to the Nifty 50, which rose 0.08%, just about managed to kind of stay above the water. And it rose on 2 out of 4 trading sessions, as you can see on the daily chart on your screen. The price is marginally below its month-long moving average, which has turned downwards. So the near term is showing a little bit of weakness. Now, there's been a bearish hammer logged on Wednesday last, and that tells you that the bulls resisted any more declines below that intraday low of that red candle. As long as that low holds, bulls are doing somewhat fine. But if that low is breached, then you have the 19,224 level, which is the low of the blue color flag formation that I have marked with 2 parallel trend lines, and that would basically spell trouble for the bulls. Let's now go to the weekly chart. And last week I pointed out the harmonic AB is equal to CD pattern. And I told you that the point D, which is close to 20,400 odd levels, will provide a substantial amount of resistance to the Nifty. And sure enough, that resistance still stays in place. What you are seeing is a bullish hammer on the weekly chart on your screen. The price is still comfortably above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So relatively speaking, compared to the Bank Nifty, the Nifty 50 seems to be somewhat relatively better and stronger poised. Do watch this moving average for signs of support. And of course, the flag formation low at 19,224. In the week before last, this index was at number 9 on our statistical beta list on volatility parameters. It fell 3 notches to number 12. So like the Bank Nifty, it's because individual stock volatility went up, and therefore the rankings have fallen. Last week, I advocated estimated range between 20,000 and 19,275, which held perfectly well. In the coming week, I estimate a range of 20,025 on the upside and 19,300 on the downside. I suggest you trade light because these ranges are likely to be violated due to the nervousness of the Middle East conflict, or possibly even a full-fledged war by the time you watch this video and market opens for trade. So let's be careful out there. Friends, now for the last bit of statistical evidence before we go to the special segment of war. So what you are seeing on the daily chart on your screen is that index futures, which are indicated as a blue line, have contributed 3 basis points lower to the total turnover. And stock futures, which are shown as a red line, lost almost half of its contribution from 0.50 in the prior week to 0.24% last week. Now, futures are the riskier segment as compared to option. They require more capital by way of span margins, mark-to-market margins. And if futures turnover is falling, it tells you that risk appetite has shrunk. I grant you the fact that the week prior was an expiry week. And like I said, due to rollover, there is dual turnover. So a little bit of a decline was natural, but decline to the extent of a high magnitude where stock futures contribution has come down by half tells you that risk appetite has gone down. Now for options. Stock options, which are denoted as a purple line, contributed lower turnover, Now, between stocks and index options, stock options are more volatile, demand more premium, and therefore higher risk appetite. So here again, in the option segment, it is only the index options turnover which went up. The lowest cost, lowest risk instrument, and therefore it basically tells you that retail risk appetite actually shrank sharply. That's not exactly very great news for a bull market. Friends, before I proceed further, let me take you to the geopolitical aspect of the market. It's not just the RBI's bond market worries that drag the markets down. Geopolitics had a big part to play. And the Israel aspect did not even come into the limelight till Saturday morning. First of all, Russian President Vladimir Putin threatened to use nuclear weapons, and he even announced the test of a new missile. That was a point of nervousness for the market. The second was after Turkey accused the Kurd militants of bombing Ankara, they carried out retaliatory attacks on the Kurd militants in Syria and claimed to have killed some of them. This is another pressure point for the market, although not as big as the Israeli one, but the markets made a note of this. And the third aspect, and the most severe of them all, which need to be discounted from Monday onwards, is the Hamas attacks on Israel. What I do know at the point of recording this video is on 6th of October 1973, that is exactly 50 years ago, students of oil and gas markets will remember the Yom Kippur War started. It changed the way oil markets functioned. It simply took oil prices through the glass ceiling, and geopolitics of the oil market changed. Almost to the day of October 6th. Of course, the attack came on 7th October, but the Hamas timed the attack in such a way that almost to the day of 50 years after the original Yom Kippur War, Hamas fired almost, or maybe even more, 5,000 rockets at Israel, brought down structures, killed army men as well as civilians, and even claims to have captured hostages. Now, the party in power is the Likud party. The party chairman and the Israeli leader, Benjamin Bibi Netanyahu, is known to be against the Iranians and the Hamas, Houthis, and the Hezbollah. There is unlikely to be any peace talk. Now do remember that Israeli soldiers have also been held captive. What is the probability of a conflict, a full-blooded conflict? I would say very high. Israel is unlikely to negotiate, so there will be fighting. Will the fighting be protracted? We can't say for sure because war is not something you and I can forecast with laser precision. But what we do know is, going by past statistical weight of evidence and past precedents, that this conflict will definitely be far shorter than the ongoing Russia-Ukraine war. It will come to an end at some point in time. So what basically triggered this attack? Now we are conjecturing here with a very high degree of probability because I do watch politics and geopolitics the world over. The attack seemed to be made with the intention of dislodging the peace process that is ongoing between Israel and Saudi Arabia. The Hamas does not consider Israelis to be friends, and therefore they are not very happy about it. Israel has already called upon the reserve troops to report to the army headquarters and has also started collecting blood for the injured. Those of my friends who followed my posts and know me long enough to know how deeply I go into the geopolitics of stuff will remember how in January 2022, President Vladimir Putin started sending medical trucks to the border of Ukraine with blood for injured soldiers. Do remember, the war actually started in the third week of February of 2022. But a full month and a half ago or prior, medical emergency supplies of both medicines and blood were being sent to the front line. Now, this was as serious as an intention to go to war. Israel has also started collecting blood, started enlisting, calling their reserve troops to report to their stations, and that means that there is a relatively speaking very high probability or almost certainty of an escalation of attacks. If oil and gas prices rise, equity markets are likely to get shivers. Now, what I have been monitoring are gold and silver prices in both the electronic markets overseas as well as the unofficial markets in Zaveri Bazaar in India. Gold and silver are quoting at a substantial premium already. This is called curb trading. Curb as in footpath, trading outside of official market hours. So curb trading rates are sharply are higher. So that tells me that the bullion market expects there to be some kind of escalation, and therefore safe haven buying has already started. Now, friends, I come to the last segment of what I would do as my strategy in the week ahead. First of all, I would watch the opening on Monday and gauge which way the wind is blowing. And secondly, I would trade extremely light. Because prices will be wild, bid and offer spreads will be yawning wide, and ingress and egress, which is entry and exit, will not be half as easy. I would shortlist those stocks where MWPL or market-wide position limits has risen sharply over the last 4, 10 and 20 weeks. Why? Because greed would have resulted in excessive positions being created on these counters, and fear would mean positions will be brought down in equally hurried manner. This is where prices will tend to be the most volatile. On the other hand, since you've already sunk in a lot of money, people might just sink more money into defending these stocks, in which case they'll open low and shoot up high. In either case, price volatility will be large. So these are counters with very high MWPL. This is behavioral technical analysis at its simplest. Wherever people have the highest amount of skin involved in the gain, that is where they will involve their skin even more or try to dislodge or free their skin from. But volatility is assured. Recent activity was built around, polarized around PSUs and PSBs, public sector undertaking and public sector banks. That is likely to continue. In the oil and gas markets, there is likely to be some impact of both the Israeli war and the strike at Chevron by the striking workers in Australia. So if at all prices do get volatile, do remember I've been telling you I don't subscribe to the hypothesis of a super cycle in the oil and gas markets. There are cyclical factors. This is the hurricane season in the US and winter demand for gas prices. Putin's threats of using nukes is another pressure point. So there could be some volatility with an upward bias in oil and gas. Would I continue to bet on theta decay in the oil markets? Yes, I would, but I would play extra safe. And like last time, I told you that if at all you are doing any such theta decay strategies in place, do also put in a tail risk hedge. That would ensure that you are protected should something go wrong. I would continue to trade light because the bid and offer spreads will be wide and entry and exit will be labored. Friends, I hope this video has helped you reach an understanding of what to expect should there be an escalation in the Middle East. Before I sign out, From this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos are helping you understand the market better. And hey, do share my video with sharp traders like yourselves and help me reach out to a wider audience. Thank you for your patience and being with me in this video. Till we meet again in my next. This is Vijay Bambani signing off for now. Have a very profitable week ahead. Bye-bye.